Hello everyone! Today, we're tackling the two-step dividend discount model, an essential tool for valuing companies experiencing high growth before stabilizing. Don't worry, it's simpler than it sounds, and by the end, you'll feel confident using this model. We'll walk through how to calculate the dividends during the supernormal growth period, the terminal value at the end of this high growth period, and finally, the present value of all these cash flows to determine the stock's intrinsic value. Let's dive into a real-world example. Imagine we're analyzing a company called Greentech Innovations, a leading player in renewable energy. The company is currently growing at an impressive rate thanks to breakthroughs in technology, but as the market matures, we expect growth to slow down to a steady, sustainable rate. Here's the data we'll work with. The company's last dividend, D0, was $2.50. Greentech's dividends are expected to grow at a rate of 15% annually for the next 5 years. We'll call this the supernormal growth period. After 5 years, growth will slow to 3% annually, the long-term growth rate. The required rate of return, which we calculate using the KPM, is 10%. Our task is to calculate the intrinsic value of Greentech stock using this information. Keep in mind that we are dealing with the same limitations as in the one-step dividend discount model. That is, if the stable growth rate, G2, is higher than the KPM rate, we would not be able to use this valuation model. Needless to say, the dividend discount model is appropriate when firms consistently pay dividends and when dividends are moving in tandem with earnings. First, we calculate the dividends during the 5-year supernormal growth period. To do this, we take the last dividend and grow it by 15% each year. Let's calculate these one by one. The first year's dividend, D1, equals $2.50 multiplied by 1 plus 15%. That gives us $2.88. The second year's dividend, D2, equals D1 multiplied by 1 plus 15%. That's $2.88 multiplied by 1.15, which equals $3.31. For the third year, D3 equals D2 multiplied by 1 plus 15%. That's $3.31 multiplied by 1.15, which equals $3.80. We repeat similar calculations to estimate the fourth year's dividend, D4, and the fifth year's dividend, D5. So, our projected dividends during the supernormal growth period are $2.88, $3.31, $3.80, $4.37, and $5.03. Keep in mind that D0 is the last dividend paid by the firm. We only use this value to calculate D1, which is the first dividend we expect in the future. If D1 is already given in evaluation problem details, you would not need D0 at all. Intuitively, a stock valuation only considers the cash flows or dividends an investor will receive after buying a stock. D0 was already paid, and a new investor would not receive it. For this reason, this dividend and any other past dividend is irrelevant for valuation purposes. Now we calculate the terminal value. Put simply, if you sell the stock at the end of year 5, this is the amount you would receive, which represents the value of all dividends beyond year 5. That is the value of all dividends after the firm has started growing at a slower stable growth rate. To do this, we use the formula. The terminal value equals the year 5 dividend multiplied by 1 plus the long-term growth rate, divided by the difference between the required rate of return and the long-term growth rate. The fifth year dividend is the last dividend expected to grow at the supernormal growth rate, in this case 15%. We multiply this dividend by 1 plus G2, where G2 is the new slower growth rate, in this case 3%. Therefore, the numerator D5 times 1 plus G2 equals the 6th year dividend. The 6th year dividend is the first dividend growing at the new slower growth rate. Since the terminal value is essentially the sum of dividends 6, 7, 8, and all other future dividends forever, we only need use the 6th year dividend to estimate the terminal value, and we do not use this dividend in any other calculation. Substituting the numbers, the terminal value equals $5.03 multiplied by 1.03 and then divided by 0.10 minus 0.03. That's $5.18 divided by 0.07, which equals $73.99. This means the value of all future dividends beyond year 5 is $73.99, but this is still in year 5 terms, so we'll need to discount it to today's value. The next step is to discount all the dividends from years 1 to 5 and the terminal value back to their present value. Keep in mind that the terminal value is the value of all dividends starting in year 6 and forever. Therefore, what we are effectively doing is getting the sum of the present value of all future dividends. The present value of each dividend equals the dividend value divided by 1 plus the required rate of return raised to the power of the year. For year 1, the present value of the dividend is $2.88 divided by 1.10 to the power of 1. That equals $2.61. For year 2, the present value is $3.31 divided by 1.10 squared. That equals $2.73. We repeat similar calculations for years 3 to 5. Finally, for the terminal value, we calculate the present value by dividing the $73.99 that we obtained in the previous slide by 1.10 raised to the 5th power. That equals $45.94. The last step is to add up all these present values to find the total value of the stock. Adding $2.61, $2.73, and so on gives us a total stock value of $60.25. So based on the two-step dividend discount model, the intrinsic value of GreenTech Innovation stock is $60.25. If the market price is below this value, it could be a great buying opportunity. If it's above, you might want to reevaluate. Certainly. You can follow the same steps using Excel. To do this, the following formulas may be helpful. Remember that this template works whenever you expect a firm to grow at a supernormal rate over a 5-year window and then slowing down. If you expect a different supernormal window, for instance, 10 years, you should calculate dividends up to year 10, and you would then use D11 to calculate the terminal value. And there you have it! Step by step, we've broken down a complex valuation model into manageable parts. You've done an amazing job following along. Remember, every complicated problem is just a series of smaller steps, and you've mastered those today. Keep up the great work, and I'll see you next time.